Welcome to Alpha Recap, your after-hours market rundown from stockalpha.ai. We're diving into the tape from Friday, February 13th. And yes, markets were closed Saturday, February 14th, and will reopen Tuesday, February 17th. As always, if you have questions, you can reach us at stockalpha.ai.
Great to be here. It felt like a classic holiday weekend trading session. A cooler than expected inflation report, a modest drop in treasury yields, and headline indexes that finished largely unchanged, even though there was a lot going on underneath the surface.
Exactly. The big picture first. Both the 2-year and the 10-year treasury yields fell by about 5 basis points after the inflation print, a move that got traders talking about a higher chance of Fed rate cuts down the road. That bond reaction helped offset some equity selling and kept the major indices from moving much at the close.
But largely unchanged was deceptive. Leadership narrowed to a handful of megacaps: Apple, Alphabet, Amazon, Meta, and Nvidia. And that concentration masked weaker breadth across mid and small caps. When a few big names carry the indexes, the picture looks healthier than it really is.
And Nvidia was a bellwether of that dynamic. It traded heavy volume, roughly 158 million shares, and finished down about 2% at $182.78. When a name that influential moves on big volume, it changes how people interpret the whole market.
Meanwhile, out on the very small end of the market, we saw extreme single-session moves. Winners that ripped and penny names that collapsed, which highlighted liquidity and idiosyncratic event risk. That's where retail traders need to be extra careful.
Let's break that down. On one hand, falling yields generally help growth stocks because they reduce discount rates for future earnings. On the other, falling yields can also signal lower growth expectations, which would be bad for cyclicals. So the interpretation split matters a lot.
Right. The 2-year yield is basically the market's short-term Fed thermometer. When the two fell, traders were basically increasing the odds that the Fed will cut sooner rather than later. The 10-year moving lower helps borrowing costs and supports long-duration names. But that support was concentrated, not broad-based.
Let's get specific on those tiny market fireworks. A couple of microcaps ran hard. One stock jumped roughly 64% to about $4 on about 27 million shares. Another jumped about 69% to around $8.63 on roughly 50 million shares.
Contrast that with several penny stocks that essentially traded to a penny on tiny volumes. One collapsed about 48% to a penny on 3.5 million shares. Another fell about 52% to a penny, but with only about 10,700 shares changing hands. Those moves can be brutal for anyone caught on the wrong side at reopening.
Those extremes underscore liquidity risk. When a stock trades to 1 cent on thin volume, it becomes almost impossible to get out without taking a huge loss. We told listeners that position sizing and exit rules matter more than ever in that universe.
Let's talk about breadth. We had cap-weighted indices propped up by those megacaps, while equal weight and many mid and small cap baskets lagged. That divergence is a red flag. If cap weight keeps outperforming equal weight, the rally is narrow and more fragile.
Some analysts say the concentration isn't a problem as long as megacap earnings remain strong. Others say it's a structural vulnerability because one bad quarter from a leader could rip the rug out. I lean toward caution. History shows narrow leadership can unwind quickly.
I'll agree with caution, but nuance matters. If the megacaps deliver consistent earnings and Fed easing actually shows up, the narrow market can persist for a while. The risk is if yields fell because growth expectations weakened materially. That's a different story entirely.
Switching gears to retail. Walmart's year-to-date momentum was flagged as a key data point ahead of the retail earnings cadence. Investors will use Walmart not just to assess Walmart, but as a proxy for consumer resilience and pricing power across the sector.
True, but remember skeptics who argue Walmart can be idiosyncratic. Company-specific promotions, inventory timing, and margin dynamics can make Walmart's results not perfectly representative of the whole sector. Still, it's the first big retail bellwether coming up, so everyone will be watching.
Let's translate some of the technical stuff for listeners who want a plain English take. A 5 basis point move in yields is modest, but it matters because it nudges probability on Fed action. Think of it as the market's collective bet moving a little bit toward cuts, and that change ripples through valuation math for growth stocks.
And breadth indicators are your health check. If advanced decline ratios are weak, while cap-weighted indices rise, that's like a patient whose blood pressure looks okay because of medication, but underlying organs are stressed. It can hold, but it's risky.
Okay, practical implication by investor type. Quick hits. For long-term buy and hold investors, cooler inflation and lower yields were supportive for high-quality growth. But this is a reminder to avoid heavy concentration in single stocks and consider incremental rebalancing.
For fixed income and income investors, short and intermediate term yields compressed, which slightly reduced the appeal of new treasury purchases. Laddering and focusing on credit quality remains sensible.
Active traders and momentum players, the microcap. Volatility created opportunities, but thinly traded names are hazardous. Use strict size limits, predefined exit rules, and watch the heavy turnover in big names. Options and volatility trades were particularly relevant after the large volume in Nvidia.
For risk-averse investors, the main signal from Friday was to be defensive if you're overexposed to concentrated megacaps or tiny cap names. Consider hedges, raise cash buffers, or reduce single stock bets if you want to protect capital.
What should listeners watch next week? First, every Fed comment and the next inflation prints. The markets gave a tentative vote for cuts, but that can flip if data or Fed speak suggests stickier inflation.
Second, watch leadership breadth. Keep an eye on equal weight versus cap weight performance and advanced decline trends. Third, monitor retail earnings. Walmart will be the early test of consumer resilience. And fourth, if you trade microcaps, tighten position sizing and be aware of reopening liquidity traps after the holiday.
Final takeaways before we sign off. 1. Cooler inflation and lower yields gave markets a tactical tailwind, but that tailwind was narrow. 2. Megacap concentration masked weak breadth. The rally felt fragile. 3. Microcap volatility and liquidity risk created both opportunity and danger for traders. And 4. Use incoming data, Fed speak and retail earnings as guideposts for tactical moves.
Nicely summarized. My bottom line, treat this environment as one of cautious opportunity. If you're long concentrated positions, consider partial profit taking or protective hedges. If you trade small caps, be disciplined on size and exits. And everyone should keep an eye on the 2-year and 10-year yields for clues on Fed expectations.
That's our recap of Friday's action. If you have questions about anything we covered today, head to stockalpha.ai where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening. We'll be back after the markets reopen with more breakdowns and trade ideas. Until then, stay disciplined and keep size and liquidity front of mind.